And really, I'll tell you, there's plenty of capital on the sideline, folks. The fact that the average accredited investor lost money, yeah, but let's face it, there's still plenty of people out there that are sitting with tremendous cash reserves that are going to be looking for great opportunities.
You're listening to Business Lunch with Roland Frasier. This is your seat at the table.
Great. So the goal here is I've worked with Brad and with several of our clients and our War Room Mastermind members and others to raise money. And he is very adept at doing that. And I wanted to have him here because I think the more that we can talk about what's going on with investors and business still managing to exist in the COVID-19 economy, the better everybody's going to be. So I want to talk about a lot of folks are concerned about having money to get through tough times. And so, Brad, can you just give us an overview right now of, I guess, first, I know you've raised over $4 billion. And so you've seen, and you've been doing it for a long time. So you've been through recessions. And I think this is typical. I mean, I don't want to call it a recession, but this is a recessionary economy at the moment based on the pandemic. So tell us, what are you doing right now? What are you seeing out there in investors? What's the sentiment? Are people still investing? Are companies still able to raise money? Give us your take on that.
Yeah, so a couple things, and thanks so much for having me, Roland. It's definitely a different world out there today than it was 3 weeks ago. I was on the phone yesterday afternoon with Matthew Knowles, who, of course, is the founder and CEO of Music World Entertainment. Of course, his daughter's worth $1 billion. She's married to Jay-Z. That's Beyonce, of course. And he made the comment to me that, over the course of the next couple of weeks going out in the future, he had a couple of large speaking engagements that obviously were canceled. And as you know, Roland, I was, of course, supposed to be there with you in Vegas next week at War Room. Speaking, of course, that was going to be a big venue for us. We were, salivating, obviously, at the people that would hopefully buy our books and be interested in what we do and our goods and services. And the goodness, though, that came out of that conversation with Matthew was we as a world are looking to do business differently. We all, have cell phones. We're living in a digital society. But what this really has forced us to do is really move in that direction, perhaps much quicker than any of us would ever have liked. And certainly there are going to be the large, big public companies that benefit from all of this, companies like Zoom, companies like Salesforce. I'm loading up personally on Netflix because I know everybody's at home with their kids watching and downloading video. So that naturally should be a company that benefits well as it relates to earnings. But when it comes to individual investors, the overall sentiment, I think, is that, number one, if I was an investor that was very heavy in equities, my thought process has now been largely awakened to perhaps I need much greater diversification. I need to start looking at things that are hard, tangible assets, i.e. real estate, putting some money to work in natural resources, investing in things like ETFs that are backed by gold or oil or real estate, or actually go out and buy the asset themselves. We're seeing a tremendous interest, believe it or not, in people wanting to invest in real estate through limited partnerships, through private non-traded REITs. We've seen a tremendous interest right now in people that are taking advantage of strategies like 1031 opportunities where they've recently sold real estate. They want to defer the taxes. And so they're investing in things like 1031s. But there's really two thought processes here. One is that a lot of the broker dealers and a lot of the investment advisory firms that I personally work with typically have mandates because they look at investing much like the endowment model, where imagine a pie and you have various sectors and you're allocating your capital to various sectors. 25% of my portfolio is real estate, 25% is going to be in equities, 10% is going to be exposed to foreign equities, a small sleeve might be invested in gold, another sleeve might be over here in private equity. And so when you look at that universe of investments, really the mantra and the message is diversification is key. so many people were so heavily weighted to the stock market that obviously it's been a dramatic awakening. Many investors obviously out there have seen the value of their investment portfolio drop anywhere from 30 to 50%. And it's happened so quickly that it's been a relative awakening for millions of people around the world. What I will tell you, I'm hearing from many experts like Bernstein Private Wealth, Fisher Investments, Ken Fisher, is this bull market that we have all seen over the last decade, and really, of course, since Trump took office with the election, is a lot of the market people thought was overvalued. It was like this tremendous run we've seen, and this extended market has got to a point where we all kind of knew in our minds it wasn't going to last forever. There was eventually going to be some type of pullback or correction. It's just that nobody thought it would happen over the course of 3 weeks. And so for those businesses and those entrepreneurs that need access to capital or are wanting to raise money through investors, there definitely is money sitting on the sideline. And what I'm seeing and what I'm hearing in the conversations we're having with family offices, that we're having with high net worth accredited investors, is they are definitely looking for opportunities and places that they can actually put their money to work. I was on the phone actually earlier today with a woman that heard me speak up in Boston, and she has a technology company that's been hit hard because what they do is they sell tickets, much like Ticketmaster, and the name of her business is called Friendly Sky. And she just signed on some major contracts with MLB, Major League Baseball. Now that nobody's going to sporting events, obviously her business has been affected. And I said, the thing that you have to think about, Tanny, is you've got a digital platform. You've got this great technology. And when you set it up, you thought about the sporting industry. But I was just on the phone with Matthew Knowles, who's in the entertainment industry, that was telling me that his daughter and entertainers are now really looking at virtual streaming as kind of the new concert of the future. If I can't get on stage in a real concert event, I can still do a virtual streaming event. And how do you monetize that? So I think what it's forcing all of us to do, including myself as well, Roland, is really to kind of make a pivot and say, what is my primary skill? What are the skills I'm really good at or that my business serves? Because at the end of the day, we all know that the exchange of capital between an entrepreneur and a consumer is really you're solving a problem. And if all of us that are on this call can solve problems and figure out how to profit from that problem that else experiences and then deliver that digitally, that's where opportunity lies. But at the end of the day, we're seeing interest from investors in funding businesses that have seen growth, that solve problems, or that more importantly, they believe in.
So that's really great. And thank you for that summary. I would love to, for all of you who are listening in, I'd love to get your questions answered about raising capital in the current environment. If you've got any questions about that Brad and I can talk about and answer. And Brad, I'm going to start with one, which is, did you sell anything last week in any units? Did anybody invest in the last 7 days?
We did, absolutely. Had one individual that you referred, which was Patch. Got a text today that his organization, Mobius, supplied money or put a check in the mail to retain us to get involved with him to actually, put together some documents to raise capital for his product.
So people are currently retaining. This is just, I want everybody to know business is continuing to go on. So people are retaining people to do things right now. So everyone is not frozen in fear. We are actually moving forward in life. It's just that we're at home, right? You get to see Brad with cool books and pictures behind him. You get to see me, hiding my kitchen back here with a big whiteboard. So the point is, everybody, that things are still going on business-wise. We're just doing them from a different place. We've got remote teams, and we're still going to need money for business. And people that have money, yes, there are still people who have money, right? After a week or two of this, that are still looking to invest it and get a return on it. And so my question to you on that front, Brad, is Are people making investments in your clients right now? Are you seeing people still funding deals?
Yeah, absolutely. There's no doubt about it. I am so closely tied to what I call the private alternative investment space, real estate sponsors, energy sponsors, private equity firms. They're still raising capital. They're still getting subscriptions. They're still bringing money over the front door. It's not coming in wheelbarrows, perhaps like it used to months ago, but certainly they are still raising capital, and there certainly still is a healthy appetite to transact business. I will tell you that people that are looking at opportunities right now are looking at opportunities in real estate. They're looking for opportunities in natural resources. The belief is that, if there are oil companies that can be profitable at $30 a barrel, certainly when it comes back, it's going to be even more profitable when it gets to 40 and 50 once again. The other thing I will also tell you is that while it's not as prevalent, there are also a certain group of investors that are motivated and are looking for investments that provide some tax relief as well. We're seeing a tremendous interest in the 1031 side of the business. We're seeing another tremendous interest in conservation easements for the affluent and the wealthy that are looking for ways to dramatically reduce their taxes. We also are talking to a client that is doing extremely well. And what they've actually done was brilliant, is they've taken their fundraising online, leveraging a lot of these crowdfunding platforms, because obviously if nobody is able to meet and nobody is able to sit down with you in a social setting, whether you're meeting at a Starbucks or whether you're meeting in somebody's office, the ability to host an investment opportunity digitally and then present those materials and documents through a platform like Accredited Investors. We know the founders there, or Jillian Hallman over at Realty Mogul. We know her and her platform. These platforms are still transacting business around the world. And so it's really the ability to understand that if you're trying to raise equity, there was actually a note here in chat. This individual is trying to raise $6 to $7 million on a $20 million real estate portfolio. How should you change your approach? It's really not necessarily changing the approach. It's engaging the investor, but doing so now in a manner where you can exchange documents electronically. Maybe what you do is you subscribe to things like DocuSign, so that when you get to the process where that investor has to sign the subscription document, either you mail it to them or you just say, hey, I'm going to send you a link. You could digitally sign our subscription documents. And then once we get those back, we'll countersign and send you wiring instructions on how you can actually fund your investment. That's what I've been doing. That's what others we are working with are adopting, is how to provide that investment experience, but now do so really in more of a digital environment. DocuSign is a great way to get signatures on documents. You can send your subdocs, you can send your entire investment package to somebody electronically, and then really just talk to them like we're doing today in some type of a virtual Zoom, so that you can explain the opportunity, respond to their questions, and then bring them in as an investor. But really, the way that we've been raising capital is talking to investors on the phone. If there's any interest, we're sending them obviously access to a virtual data room, or we're sending them documents as attachments or to a Dropbox links. Then we're following up with them the following week to really walk through that, kind of giving them a presentation, responding to their questions, and hopefully closing them on the idea of, makes sense for you. Sounds like there's desire. Get out your checkbook. Let's tell you how to enroll. And either they're sending it back to us in an envelope, or we're actually accepting investments via wire or ACH. And then what they do is they just digitally sign everything with DocuSign, and boom, signed, sealed, delivered.
Love it. So I got lots of questions here, and I'm going to start with, let's see, we've got Matt Bodnar says, I'm in the middle of raising 6 to 7 million of equity for a $20 million real estate deal. It's a portfolio of triple net single tenant properties. How should I change my approach, pitch, etc., to equity investors based on the current market dynamics?
Yep, great question, Matt. It gets back to what I said earlier, and that is the focus really that I would try to communicate to investors is that this is a tangible asset. Triple net lease, single tenant has been a great space to be in for investors. And really, I think what you want to be talking about here is really more the benefit to the investor rather than the feature. In other words, it's one thing that it's, single tenant, triple net, but really what I would be doing is focusing the conversation more on what it can do for the investor, i.e., are you making distributions where you're sending investors checks? It could be monthly, it could be quarterly. People like to see a return on their investment. What are some of the tax benefits or some of the tax relief that will offer to the investor? What's the anticipated hold or the time horizon? Because really at the end of the day here, what you want to try to do as you're having that dialogue or conversation with investors is not necessarily talking about what it is. You want to be talking about what it does. What it does is it provides basically the foundation for your investment portfolio. It's providing an investment in something that's not going to be whipsawed or have these dramatic swings like we've seen in the stock market. It's a hard, tangible asset. And so I think, Matt, from that approach, you definitely want to be stressing more the features of what a investment in single triple net does. But also it's really the approach to the investor is, if you've been meeting with people there locally at Starbucks or having them meet you there at their office, what you really need to do now is take that conversation to a more virtual environment and do something like we're doing now, whether it's Zoom or whether it's just a telephone call, and then exchange the documents that way so that you can still raise the capital. Because at the end of the day, we're still raising capital in what we're doing, and a lot of the clients I'm working with are still raising capital as well. It's just that you really need to focus more on the benefit to the investor of investing in a hard, tangible asset that is going to hold value, provide income distribution, some tax relief with capital upside appreciation, and really communicate that strategy to them that way so that they see the benefit of adding this to their portfolio to provide that diversification that is going to be so key going forward.
With respect to him, he's talking about folks about real estate investing in triple net properties, right? So
Yep.
let's see, of equity for a $20 million real estate portfolio, how should I change? So would you speak then, Brad, to the current economics and Matt, I don't know if this is raising to acquire, because if it's raising to acquire, I think it's a fantastic time to be a buyer. So I would lean in heavy to look at what's happening. The property is still for sale and prices are more affordable, which means we're going to be able to get, even once we get this money raised, we're going to be able to pick up properties at the best price and on the best terms. Interest rates have been slashed to zero at the Fed. So our financing that we're going to do on these properties, if you're doing financing, is going to be more favorable. So all of our numbers, we're revising our numbers right now to reflect the anticipated improvements and opportunities that exist. But the reason that you should do this right now is that this opportunity is only going to exist, we think, for about 90 to 120 days. And it's going to go back to normal. And then everything's going to take off because all the pent up demand, all the deals that have been put on hold are going to go forward. So if you're going to do this deal, now's the time to do it. Matt, that's to me the way I would phrase that. And I'd love to hear if Brad has additional ads there.
No, I mean, you're exactly right. I was on a call yesterday with a gentleman in Atlanta by the name of Chris Swan. Chris runs a large family office there. He was a former hedge fund guy. He's got a company called Cygnus Capital. And what they do is they buy defaulted real estate debt. And then, of course, his team unlocks the value in that piece of real estate and then obviously looks to monetize that and dispose of that typically within 24 to 36 months. And he's, typically buying stuff 50, 60 cents on the dollar because it's defaulted debt, it's in foreclosure, and he's an expert in that market. He said, man, we are salivating right now. There are so many deals out in the marketplace. He said, finding deals is not my problem. It's getting more capital. And so, we're really reaching out to investors because the opportunities that are in the marketplace are not going to be there forever. Yeah. There's this tremendous window of opportunity that you have to communicate, like Roland just said, Matt, and to the others that are on this call, where the deal that was a good deal 3 weeks ago is even a better deal today than it was then because of all of these things. And for us to not have the ability to take advantage of that is really a detriment. That's why we need you, Mr. Investor, is that what we thought was great a month ago is even better today for these reasons. Interest rates are going to obviously be better. The outlook of what we're seeing in the market is going to be better. And so, that's really, I think, what Roland was getting at here is you have to be able to communicate the fact that what you're seeing out there is tremendous opportunity, and be able to basically explain to people that we want to take advantage of these opportunities that are being created by the lowering of interest rates. Because obviously what was attractive, 3 weeks, a month ago is actually, I would think, even more attractive today, and will become more attractive as people realize that, hey, I got to do something here, because if I'm sitting on the sidelines and I'm not putting my capital to work, shame on me.
Jason says the problem is that in this market, single tenant, triple net properties are often retail and restaurants. But Jason, to me, that goes back to exactly what we're talking about. The things that are the hardest hit are going to be the best values to buy. So your projections, if you believe, and I believe that most people do right now, that the economy is going to come back with a vengeance in third or at latest fourth quarter, then the fact that you're able to pick up hard hit retail and restaurant properties is going to be a tremendous opportunity. And Jason added, he said, I was in the middle of negotiating acquisition of a $23 million shopping center for one of my clients. We're still pushing forward, but with a decent price reduction in mind. Exactly. So exactly. You get that, Jason, for sure.
Yeah, exactly, Roland. And just jumping in real quick on that one, that was my point, is if they're going to maintain their 4 cap requirements on a Starbucks, signalized corner, it'll bounce back. But I think in the short term, purchasing them for what they were listed for a month ago is not happening. At least I won't let my clients do that.
It's time to renegotiate, right? Absolutely.
And single tenant properties to me are always risky. I like shopping centers with multiple tenants. So if you have a vacancy, you're down to 92% occupancy, not down to 0. That's just my personal opinion. But anyways, we'll continue on.
I would agree with Jason's sentiment. I mean, I'm a much stronger proponent of a shopping center where, you may have an anchor tenant like a major retailer, but then obviously you've got your Starbucks, you've got your dry cleaners, and you've got your nail salons, because obviously, like Jason's comment is,
diversify your risk as always.
You're right? Not losing all the income. Hopefully you can operate the property at 60-70% occupancy, where you have a large big box single tenant. It's a good model if it's a good, reliable company. There was a company that I actually worked for many years ago called AmREIT, which went public and traded on the New York Stock Exchange. Their model was big box, single tenant, a triple net, but they had a credit theory that said any one of the tenants that we lease to have to have at a minimum a $40 million net worth. So they were CVS, Walgreens, Wells Fargo, banking locations. On the restaurant side, Golden Corral, TGI Fridays, to make sure the quality of the tenant that was in place was large enough to obviously continue making the payments on the lease in the event that there's adversity in the marketplace. So that if you're leasing to a mom and pop that is obviously of a smaller risk profile, then obviously that's where you're going to run into problems.
Scott says, is it attractive to get investment with the potential of talent, resources, etc., being cheaper for development of your product? The answer is yes, but let's talk about how can we use that, given the fact that we are going to assume that it's more attractive to get investment with talent, resources, et cetera, being cheaper. How do you take advantage of that, Brad? Do you go in, do you revise your use of proceeds, revise your numbers and some of maybe your team, maybe quality of team? Is it time to maybe relook at that? Can I upgrade the people that are in my prospectus? What do you think?
Yeah, I think that certainly you want to sit back and reassess what you had pro forma'd. And obviously, if labor is going to be cheaper, if resources are going to be cheaper, that's obviously going to have an effect on the underwriting and the due diligence that you've done on those individual deals themselves. The other thing that we've also been recommending to our clients, understanding that we're really going to, quote, a digital world, doing a lot more business electronically this way, is to structure the investments themselves where you can take advantage of crowdfunding and your platforms like LinkedIn and Facebook and Instagram. With the new legislation, when you structure your offerings under the Reg A or the 506C, you can actually advertise that investment opportunity in social media saying, hey, we've got this great multifamily, or we've got this great real estate opportunity. If you have an interest, please communicate with us. You're not able to do that with certain structure like a 506B. But if you're familiar with these various legal structures as it relates to the offering, limiting yourself to deal exclusively with accredited investors, you can promote this on your Facebook page. You can promote this on your LinkedIn page if you have a company page. There's a company out of Dallas called Origin Investments that we follow. And, they're raising hundreds of millions of dollars a year because they've structured the investment offerings correctly, and they're able to use that aspect of social media to raise capital. Grant Cardone, same thing, of course, he's raised hundreds of millions of dollars for his multifamily because the structure of his offering documents allow him to promote it on his LinkedIn and through his social media. And obviously the investors he's dealing with there are accredited as well. So realize if we're moving to a digital world, you need to take advantage of your social media to attract the investor to what you're doing. And by structuring your offering documents in such a way that allows you to do that without getting into trouble with the regulators, it allows you to open up that door and make that opportunity available to a much larger, broader audience of people.
Richard says, what's the best way to find the right combination of buying existing non-competing companies and funding independent holding company? Okay, so let's finding existing non-competing companies. Let's talk about that a little different time because that's a different topic. I just want to talk about the funding right now, Richard. So Brad, if you were trying to fund an independent holding company right now, so this is basically a blind pool, I think we're talking about. Would you explain what a blind pool is and how would you go about doing that in this environment? I think it's easier now based on the opportunity factor.
Yeah, I would agree. A blind pool offering is simply an offering where you're looking to raise capital. And when you start the process, you haven't identified anything. In other words, you're saying, okay, we've got this $25 million real estate fund, but we haven't identified any piece of real estate yet. We don't know what we're going to buy. We don't know what we're going to put into the fund. And as we raise capital, the capital that we bring in will then go out to make acquisitions. That's very different than saying, hey, I've got this apartment building under contract. I'm now trying to raise capital, where investors can actually look to that specific piece of real estate and understand exactly where it is. That's an identified asset. What a number of the sponsors that we're consulting with are doing is they're seeding their funds with one or two assets so that they can point to a specific piece of real estate to kind of accelerate the process. Another thing that we're also finding a lot of the issuers doing is offering incentives to the early stage investors, giving them a higher preferred rate of return. So as an example, if you've got a real estate deal and you say to the investors, our goal is to provide you with an 8% distribution paid out quarterly, what you might do is say to the earlier stage investors, maybe the first $2 million you raise, for coming in early and allowing us to get access to your capital sooner, we're going to increase that preferred to maybe 10%. So you've got basically two share classes, a early stage investor that gets a higher rate of return, and then what you would call everybody else that gets a little bit lower rate of return. That really just helps you get out of the gate. It helps you close those people that you're talking to, because it's like, look, if you want to wait, you're going to get a lower rate of return than investing and making the decision to invest with us today.
I want to take Merrick's question. He's asking, and I think it's very timely, is there anything that you would do different if you're raising production capital for a fully remote company? Because his team and all the professionals and everything is scattered all over the world. Is there anything different that you do there? Or is it kind of just basically the investors don't care?
Investors don't care. Investors really, at the end of the day, don't care whether you're in one office or whether your team is spread out across the country.
I might position that, though, as a huge advantage, Mark, that when things like this happen, if there are pandemics or terrorist attacks or huge recessions or real estate collapses or whatever, that a fully distributed remote workforce is almost unaffected because they're all working from the place that they live. So even in natural disasters, you're spreading your risk of non-performance out over a large geography, which is an advantage. And so I think I would lean into that heavy right now if you're raising money and pitching anyone on something like this.
Yeah, I mean, I think that the geographic diversity of an organization, the fact that you're spread out, is actually a strategic advantage given where we are today and what's going on in the greater economy. I work with a lot of big real estate companies like Waypoint Residential that have multiple offices spread across the United States simply because they have projects and they have properties located in different markets. So they have an office in Austin, an office in Boca, an office in Greenwich, Connecticut, offices in Chicago. The fact that we're working from home really has no bearing on that geographic diversity. So I would agree with what Roland just said in that sentiment, is that that's actually, I would view it as an asset.
Love it. Matt says, if I want to pursue distressed opportunities, can I do that as an independent sponsor? That is, without equity pre-committed, or do I need to have the cash ready beforehand, assuming stuff gets distressed? And you can raise a blind pool. I think you don't need to have the equity pre-committed unless they're going to ask for that as proof. So if they're super panicky and super detailed, just like some people ask for proof of funds in a real estate deal, some people ask for proof of funds in a corporate acquisition deal, some people don't. I think there's going to be a lot of seller financing available. So
I would agree.
Yeah. So I don't think you need it. I would go forward immediately, regardless of whether you've got that or not. Richard asks, Brad, are you working with people looking to roll over their capital gains sales proceeds into businesses or buildings in opportunity zones? You finding many people that are interested in opportunity zone? Is that a good thing for him to look to like make his deal fit into one of those areas?
Yeah, I'm very familiar with opportunity zones. We're actually working with a number of clients that are in opportunity zones. Certainly, there's tremendous interest. There's been tremendous discussion around that.
And if you guys don't know what those are, and some of you that are listening internationally, it's a opportunity zone is a thing the government has enacted that allows you to defer the taxes on sales of certain assets if you invest in certain areas where they want to incentivize economic upticks. So that's kind of what that is. Go ahead, Brad.
Yeah, and so to get back to that, it really depends on what the asset was that was sold that somebody wants to invest in an opportunity zone. We found that the advice given to, quote, real estate investors, if you're selling real estate, using a 1031 strategy and rolling that into another replacement property or going into a securitized transaction like a DST or a TIC, is probably better than in an op zone, because in an op zone, obviously you have to hold the investment for 10 years to actually see the benefit of the entire deferral. Another piece of real estate, you might be able to get out of that in a shorter duration. Certainly, if you're selling a business or if you're selling high appreciated stock and you want to put that into an opportunity zone as a way to defer that, there is tremendous benefit to that. And I would say the answer to that is 100%.
Would you define your DST in TIC terms?
Yeah, absolutely. So when you have a piece of real estate and you're looking to sell, obviously, if there's capital gains, the government allows you to take advantage of something called a 1031, which is a strategy of reinvesting the proceeds into like-kind property. In the world of 1031, there's really two approaches here. One, of course, is you can work with a realtor or a real estate broker, and as the owner of that real estate, find another replacement property that you're personally going to own and invest in yourself, and then just roll the proceeds over. On the other side of the fence, through a lot of these large real estate sponsors and issuers, we have what we call securitized 1031s, where you've got a big sponsor that's an expert in whatever it is they do. Maybe they invest and own high-rise office buildings. Maybe they're a huge multifamily sponsor where they have 300-400 unit apartment communities. And what they do is they package these up as an investment to bring individual investors in. A Delaware statutory trust is one of the recognized structures that the government and the IRS recognizes, that where really you have a trust that owns the piece of real estate, and then all of these individual investors are coming in basically underneath the trust where they're beneficial owners. And the IRS allows that because the benefits of the trust essentially pass through to the individuals. The other structure that's also used frequently is what we call tenant in common. And that is where you have a lot of individual investors that are tenant in common owners in the underlying asset themselves. We are seeing a lot of interest in that. Opportunity zones certainly are very, very hot as well. And we're seeing the opportunity zones really as an opportunity for people that have sold businesses or have come out of highly appreciated investments in stock or other things that, quote, do not allow them to take advantage of a 1031 because it was not a real estate investment that they exited. It was something else. But both of those structures certainly we're seeing a lot of interest in, and I can certainly help you if you have an interest in structuring a opportunity zone type investment, because I work with a couple of experts that are broker dealers and investment advisory firms that have been doing that now for a better part of over a year now.
I got some objections for you. So Matt says, recent investor said we are holding capital for distressed opportunities right now and not investing in anything.
Mm-hmm. You know, what I would say to that really is ask them what type of distressed opportunities they're looking for, and say, other than that, is there any reason that you're not wanting to move forward or invest with us today in the opportunity we're currently discussing? Try to isolate that objection and find out realistically if that is the objection or whether they're just throwing that out there where really there might be something else behind that they're either not disclosing or that you're not saying.
Yeah, I like that too. I love that, Brad. To basically drill down, Matt, and say, so what is a distressed opportunity? Define that for me. And then once they define that, then you can say, well, here's how what we're doing meets your criteria. And maybe it doesn't. If it doesn't, then that's they're not the investor for you. But if it does, then you've got something. Instead of you've moved them from a general objection to a specific objection, you can address and overcome a specific objection. It's hard to overcome a general one. Marek says the objection is that we're a remote team, so not located in one country, which goes against where we are right now. Thanks to COVID-19, we're all remote. The investors need to find out how to invest in teams that bring value and building valuable companies, whether the team. So how, if you're getting, and I think we kind of addressed this, but Brad, if somebody says, you know what, man, that thing you're trying to get me to invest in, I don't know, the people are all over the world. That scares me. What do you say to them?
I would get back to kind of what we said earlier is we perceive that actually to be a strategic advantage because we all are working remote. We all are safe. We're all not engaging. We're all obviously at more than 6 feet distance between other coworkers. And so the chance for us to essentially become infected has been dramatically reduced and minimized. And I would just throw it back to them and say, just out of curiosity, do you own stocks like Amazon or Apple or, others? Well, sir, of course. Well, they've got employees all over the world. We're no different other than we're just a smaller company.
You're already investing in distributed remote teams.
Yeah, exactly. You're already investing in companies that have employees all around the planet. We're just a little smaller in scale, but essentially you're already doing it.
I like it. And so Heather asked, she said she's interested in investing in some local restaurants and businesses that have been hard hit, but the transaction sizes are small. Should she use a fund to do something like that?
Yeah, I would certainly use a fund. And one thing I was going to comment on and add, Roland, is, we got so many people on the call. Obviously, everybody has, different net worths, different reserves, et cetera. If you're trying to acquire a piece of property and there's a time horizon attached to that where you need to close in 90 days or you need to close over a period of time, and your concern is, hey, it may take me longer to round up all these investors and actually raise the capital. Depending on your resources, I say if you can commit and take down the deal yourself, take it down and own it. And then what you can do is actually you can get an investor base behind you, essentially to, quote, take you out of the deal. My partner and I have actually done that on some stuff that we've actually done where we'll go out and buy the property knowing that we can do it internally, and then we'll raise the capital and basically sell it to the investors, but we do so without a markup. So there's no conflict of interest or there's no self-dealing. We just basically cash ourselves out of the deal. We retain our general partner ownership in it. So we're going to benefit as the general partners, but essentially we're able to pull our money out. It's like a cash out refinance, but essentially instead of cashing out by a bank, we're cashing out by a group of investors that are basically allowing us to pull our equity back out of the deal and then go do something else. So depending on the resources that you have as an individual or that you have as a team, if you are seeing great deals and great opportunities out there in the marketplace, my premise is get your hands on those deals. Don't let those good deals fall through the cracks or slip through your fingers, because once you own it, you can always figure out a way to get investor capital to recycle your equity and pull it back out so that you can then go out and do something else.
Yeah, and what you just said to me applies to what you were saying too. Objection, they're going to wait till the situation blows over. This is exactly how you address that. Now, Patch Baker from Facebook says the objection that he's getting is many people are worried about the market in general. So they're stockpiling cash in bank accounts instead of putting money into deals or new ventures. How do you deal with people who are saying, I'm just stockpiling my cash right now?
Well, I mean, I would just ask them, what are you stockpiling for? Mm-hmm. Are you stockpiling for this to blow over where you're going to, invest 6 months from now, whether you see signs of a healthy economy and a rebound in the market? And if they say, yeah, say, well, if the market's here at 23,000, are you going to wait for it to get back to 26? And if you do, and that's when you're going to get back in, you've missed all the growth from where we are now to where, quote, you're wanting to be. The smart people are actually putting to money work in tranches. So as an example, if you're sitting there with $100,000 and you see a dip in the market, you don't put $100,000 to work at that dip, because obviously we know there might be more downside. You say, okay, let's take 10,000 or 15,000, buy in at this dip, and then you buy in maybe a few weeks later at the next dip, and you kind of deploy that, what I call dollar cost averaging mentality, so that you're putting your capital to work, but you're doing it over a period of time, so that if we're, quote, not at the bottom, you're not going to be as hurt dramatically, but you're still buying a lot of these great opportunities that are distressed at great rock bottom prices. But if you're talking to somebody that says, hey, man, we're just stockpiling, we're just waiting for the right opportunity, the end of the day, man, it ain't ever going to be right. The right time is now. It's like marketing. Marketing it's not something that you did, it's something that you do. And I'm talking to business owners that are like deers in the headlights that are pulling back on their marketing budget. And I say, if you're pulling back and you're hoarding cash, you're not thinking with the proper mindset of an entrepreneur or a big person. An entrepreneur and a big person says, hey, I've got to continue doing the things that I'm in control of. It's what I call the circle of control. You don't want to live in a spirit of fear. And so really the proper thing to be doing is to be active, to continue investing in your marketing, because marketing is not something you did, it's something you do.
Love it. So Jason Humphreys from Facebook Live says, any thoughts about syndications of multifamily? And do you think those syndicators bought, like Grant Cardone is probably one of the more public that's been buying tons and tons of stuff, and he's got a pretty expensive deal at 3 and 30. That's what I hear it is anyway. Did they buy too high over the last 18 months? And if they did, or if you're in a deal where the things that, this would probably be a really good take on this for everybody, is if you are raising money now and it looks like you're kind of in some stuff that's going to cost you too much given where the economy is going to be for the next few months, how do you deal with that? How do you deal with that with your investors?
Obviously, being a real estate investor, my sentiment is absolutely, Jason, 100%. I've seen people that were buying what I call trophy assets, literally at 4 caps. I think that as a multifamily syndicator or a multifamily sponsor, there have been plenty of people out there, Grant Cardone just being one of many, that really benefited tremendously from cap rate compression. And as a result of that, they obviously saw a tremendous increase in the valuations on properties that they had acquired in that environment. Now with this new scenario, I think it's going to be a rude awakening for many of those multifamily sponsors that really saw cap rate compression benefit the appreciated value they saw, where if they're not a vertically integrated operator and they're not hands-on creating and adding value to the real estate, we may encounter some bumps in the road, and they may encounter some problems related to properties that they got themselves into. I won't say that they bought too high. I certainly have seen a lot of people do that. But as a multifamily investor, I think that those that are buying B-, C+ properties that are in great locations, that go in, do the rehab, add some renovation, put some lipstick on, and are vertically integrated where they're hands-on and operate themselves, they're the ones that are going to do great in any environment. right? Because they're operators.
Yeah.
Those
And
that
Richard,
just
Richard
bought,
just asked that. He said,
those that just bought to buy, and those that bought these trophy assets, in a recession, let's face it, folks, if you're a guy that, a year ago went in and signed a lease on a $3,000 multifamily asset that was an A++ property that had all the amenities, and you're sucking wind right now, and you don't feel as rich as you did because your investment portfolio just tanked 50%, or maybe your employer came and said, hey guys, our company's being affected across the board. Every employee here's taking a 20% pay cut for the next 6 months until we get back to normalcy, which I guarantee will happen with a lot of these big companies. They won't make major layoffs, but they will certainly reduce compensation. They'll tell all of the people in the company, hey, mandatory company-wide 20% pay cut. You're still employed, you still have your job, but you've got to take a 20% pay cut because the company can no longer operate at the salary level that we were at pre-corona. And so while you do still have a job and still do have income, certainly you're going to see a reduction. I guarantee people are going to move out of those big Class A multifamilies that had all the amenities, and they're going to be looking for less expensive housing options. You're going to see the same thing as well on the single family side. So
and companies. So I don't want to be too obsessed with real estate here, because there's definitely lots of real estate opportunities, but everything that you're saying about real estate applies to companies as well. Brad, let's wrap up with and Stuart, you asked about what I think about the immense opportunities in this environment. And as a fellow introvert, how are you enjoying some house arrest? I like being arrested in my new house if I'm the one doing the arresting. If anybody else is arresting, that doesn't sound as fun. But I'd love to chat about how you're dealing with people who have invested that are trying to get out, Brad. Are you getting any investors that are calling saying, man, I cash is tight. I put that money in when I thought things were good, and now it's a different world. I'm freaking out. I need my money back. How do you respond to those people?
Certainly, there are some. Some of the deals that we've actually structured do have a redemption feature for hardship, and for people that are unemployed or people obviously that are experiencing hardship. You always really want to try to help an investor if you can. What we always try to do in our deals, and what I always recommend, is if you can find an investor that is sitting on cash that wants to acquire additional interest in the deal or take on a larger position where essentially you can just match them up to buy somebody else out. At the end of the day, really, you never want to have a disgruntled investor or anybody that's experiencing hardship, because that just is not a good investor to have in your program. With that being said, there's
a process though, Brad. So somebody calls and says, exactly what I said. I need my money back. I'm not going to do the deal anymore.
Yeah.
What's the process that you walk them through?
Typically what we do is we reach out to our investor universe first and say, hey, we have an investor that would like to redeem. Do any of you as existing investors have the interest perhaps in getting additional units, obviously at a discount, because the investor needing cash realizes they are going to take a hit instead of holding it to maturity and seeing the full benefit. So as an example, if you put in $10,000 and you're a year and a half into the deal and you get out, you might have somebody say, yeah, I'll buy you out for $7,500. Well, if you need cash desperately, that's a good deal for you, because you have really no other way to go. Right. For the investor basically buying something that was valued at $10,000 at that discount, when that investment matures in 2 years and it's worth $15,000, they obviously hit a home run because they were able to come in and acquire that at a deep discount to its inherent value. So we always try to provide that out by going to our investor base first. If we can't do that, typically what we try to do then is to do it internally through the redemption feature, where we have terms delineated in our private placement memorandum. So we outline a series of steps. The first step is, if you need out, we go to our existing investor base. Try to find an investor there to match you with. If that doesn't work and we have the resources, we'll take you out internally based on this formula. It's not a guarantee that we will do that. And then the other thing, of course, we do is we limit the amount of redemptions over a period of time so that, quote, we don't have a run on a bank. Because in an environment like the one that we're in today, you can imagine, to a general partner in a deal, if you had 40% of the investors come to you and say, hey, we all want out, there's really not the ability to, quote, get you out, because we ourselves don't have the capital to do that. And we don't have enough investors over here that provide that liquidity feature as well. But for those that want to get out, they do need to understand, more than likely, you are going to take a hit. Number two, if you have other places to go for capital, I would recommend you look there first, because this investment will perform. And if you hold it to maturity and you hold it through to its fruition, you will do much better than getting out today. So there is that formula that we do go through in trying to provide liquidity to our investors that really do need to get out.
I love it. Brad, I had a few people ask how they could get a hold of you. They're interested in having you help them with fundraising. What is the best way for folks to reach out to you? And I also want to give a shout out to Jillian Sidoti, who is on the call, who is an attorney and member of War Room, who does private placements and did them for Grant Cardone and a whole bunch of other people. So if you're looking for a good attorney, you can hit me up or message here and we'll get you Jillian's information. Brad, how do people get a hold of you and work with you?
Yeah, no, absolutely. Thank you so much for Roland. Two ways. Number one is I'll give everybody my telephone number. You can jot it down. Please don't everybody just call right now, because my phone will ring off the hooks. But my cell phone number is 713-398-3130. So again, 713-398-3030. My email is simply Brad, B-R-A-D, at bradblazar.com. And my last name is spelled B like boy, L-A-Z like zebra, A-R, Brad at bradblazar.com. My website is just www.bradblazar.com. That talks about our coaching services, the books that I have out in the marketplace, my speaker, if you want to have me come in and speak to your organization as a speaker as well. But that's my phone number and that's my email.
Perfect. And is there a website too, Brad?
Yeah, the website really doesn't focus on, quote, raising capital. It's really more for the books and the coaching and the speaking, and that is simply www.bradblazar.com.
Okay, great. And I've got Jillian has put her number in chat, so I will put that up too. Jillian's at crowdfundinglawyers.net. So if you guys want to get a hold of Brad, and there were a lot of questions that we didn't have time to get to, feel free to reach out to him. He's a super awesome guy. I've enjoyed working with him, and he takes good care of people that we send his way. And if you have any questions, feel free to hit him up or me up. Brad, thank you so much, man. I really apprate you coming in and sharing all your...
Absolutely, Roland. That's a pleasure. There's a world of opportunity out there today, folks, more so than before, perhaps. I know that many of you out there don't see that. Perhaps you don't yet perceive that, but in talking to a lot of the big thought leaders that I've networked with, like Roland, Larry K. Benet, Matt Knowles, Dr. Stephen Hotze, who's viewed as one of the greatest wellness physicians. He's got clients all around the world. Really what we're all trying to figure out is how can we just make a small pivot in what we're doing, learn to do it differently, but still connect to the same audience and still drive revenue and profitability, but really now just do it in more of a digital world. The world of real estate will always be the world of real estate. The world of raising capital will always be the world of raising capital. It's just that you have to think digitally now and figure out how you can do that and take that opportunity to the internet. Crowdfunding platforms, I think, are going to benefit tremendously over the next 6 to 9 months. CrowdStreet, Realty Mogul, all of these platforms, I think, are going to just see tremendous opportunities. And really, I'll tell you, there's plenty of capital on the sideline, folks. The fact that the average accredited investor lost money, yeah, but let's face it, there's still plenty of people out there that are sitting with tremendous cash reserves that are going to be looking for great opportunities. And the only thing that really you have to have is the courage to actually reach out and talk to them. I say there's plenty of opportunity out there, but the reason that a lot of people don't go after that opportunity is they don't lack the courage. You got to pick up the phone, you got to send the emails, you got to do the follow-up, and if you do those things, I guarantee you'll be successful. We're finding it in our own business, and we're finding it in the businesses that we consult.
Awesome. Thank you again, Brad. Thanks, everybody, for tuning in.
Take care, Roland. Thanks so much.